mind, looking for a dime. James Locke in the house, gonna help you shine.
Welcome to the Pool Lock YouTube channel. I'm James Locke, and today we're going to answer some of the Ask James questions of the day. So we have the first question is from Kelsey. She says, I have a mortgage. I was able to get a 4% loan. Clearly, I don't want to pay that off, right? All right, Kelsey, let's dive deeper into whether paying off your mortgage early makes sense in retirement, especially when focusing on income generation, reduced risk, and managing cash flow effectively. First, the decision hinges on several factors, starting with your tax situation. Now, with recent changes in the tax code and the increased standard deduction, many people no longer itemize deductions, including mortgage interest. So if you're taking the standard deduction, you're essentially paying your mortgage interest with after-tax dollars, which increases the effective interest rate you're paying. For instance, if your mortgage interest is 4% and you're in a 33% tax bracket, the after-tax cost is around 6%. This means your investments need to earn more than 6% to surpass the cost of your mortgage interest. Secondarily, in retirement, it's not just about, comparing your mortgage interest rate to potential investment returns. Cash flow management becomes crucial. When you make mortgage payments, you're paying both principal and interest. So to determine if it's financially advantageous to keep the mortgage, you need to consider if your investments can generate sufficient income, including interest and dividends, to cover your mortgage payment. Often, the income from investments may not match the total principal and interest payments on your mortgage, especially when considering reduced risk and volatility in your investment choices. Moreover, there's a psychological benefit to owning your home outright in retirement. Eliminating a mortgage payment can reduce financial stress and provide more stability in your monthly budget. And this is particularly valuable when you're relying on fixed income sources like Social Security and retirement account withdrawals. Ultimately, the decision to pay off your mortgage depends on your individual financial situation, risk tolerance, long-term retirement goals. It's essential to weigh the tax implication, investment returns, and cash flow requirements before making a decision. Now, for many retirees, reducing debt and securing a mortgage-free home can provide peace of mind and financial flexibility, allowing them to allocate more resources towards income-generating investments that support their retirement lifestyle. It's a great question. As always, if you want to send in your question, you can do so by emailing that question to poollock@poollock.com. All right, let's go to our second question. This is from Taylor, and he wants to know, can I take out a loan against my 401k? Is this the worst idea ever if I really need the money? All right, absolutely. Taking a loan out against your 401k can be a tempting option when you need cash. But let's explore why it's not always the ideal choice, especially when we focus on retirement income, reduced risk, and that volatility. You're in a situation where you need money, and borrowing from your 401k seems like a viable solution because you're essentially borrowing your own money and paying yourself back with interest. Sounds good, right? However, there are critical considerations to keep in mind. So first, when you take a loan from your 401k, that money is no longer invested in that retirement account. Right? This means you miss out on potential growth and earnings that your investments could have generated over that period. For instance, if your retirement investments typically earn an average return of 7% per year, by borrowing from your 401k and not having that money invested, you're foregoing that potential growth. Second, the interest you pay on the 401k loan is not tax deductible. Unlike mortgage interest, for example, which can be deducted in many cases, the interest on a 401k loan is paid with after-tax dollars. Moreover, when you eventually withdraw that money in retirement, it will be taxed again. as ordinary income, effectively subjecting it to double taxation. Furthermore, the opportunity cost of a 401k loan is substantial. If the market performs well during the period you have the loan, you miss out on those gains. Now, conversely, if the market declines, taking the loan might actually protect you from losses, which could be seen as a benefit in that scenario. Ultimately, the decision to take a 401k loan should be weighed against other sources of financing, like considering factors like interest rates, repayment terms, your overall financial goals. In some cases, especially if you have no other viable options, or if the need is urgent, a 401k loan might be the least detrimental choice. However, it's crucial to understand the full implications, including potential long-term impacts on your retirement savings and financial security. As always, it's advisable to consult with a financial advisor who can provide personalized guidance based on your specific circumstances. They can help you evaluate alternatives, assess the true cost, and make an informed decision that aligns with your retirement income objectives and risk tolerance. So, in lots of these videos, we talk about insights on managing your retirement finances effectively and optimizing your investment strategies for a secure retirement. That's what we're always talking about. Remember, knowledge and careful planning are key to navigating financial decisions that impact your future stability and well-being. Great questions today. As always, if you'd like to send in your question, we'd love to have it. Email that question to poollocke@poollocke.com. And if you like what you heard, go ahead and like and subscribe to our channel. I'm James Locke, your retirement income source. I'll see you next time.
Money on my mind, looking for a dime. James Locke in the house, gonna help you shine. Retirement is near, don't you live in fear. Listen up, my friend, let me make it clear.